With Apple launching their 4.15% APY on their savings account, which is essentially about 10 times more than the national average of 0.35%, doesn't it make you wonder why different banks all have different interest rates? First of all, it's important to realize that not all banks make money the same way. For example, some banks place less emphasis on net interest margin and more on fees or sales. A bank can also make money by charging administrative fees, selling financial products like mutual funds, or even just charging people for deposit boxes. Banks like this that focus on fees and sales don't make their money from interest rates, so you might find their interest rates on deposits much lower. Second, some banks are less reliant on deposit for funds. Instead of relying on deposited cash for funds, banks can also borrow from other banks, corporations, or government events. Banks like these can borrow from investors by issuing bonds or raising the capital by issuing more shares. Lastly, banks constantly fight for market share to obtain more customers. Sometimes banks will drop their loan interest rates for special promotions to capture market share and to lure in more customers. In particular, online banks with relatively low fixed costs tend to attract more customers with higher APYs than offline banks.